And the three main ways that you can diversify are via geography, via... What's up guys? Welcome to Millennials with Money, the channel that helps you take control of your money and create a bright financial future. I'm Johnny, and if you like today's video, make sure you hit the like button, click subscribe with the notification bell, and tell another millennial. There's an expression in the English language which says, you shouldn't put all of your eggs in one basket. That basically means don't rely on one thing as your only plan of action or as your only hope for success. When it comes to investing, this is applicable as well. Unless you're Warren Buffett, who doesn't believe in diversification, you should consider diversifying your investment portfolio. And in this video, I'm going to explain why. So without any further ado, let's get straight into it. So why diversify? Well, when we invest, it's normally because we want to preserve our capital and give it the opportunity to grow over time. And as such, we need to invest to do so. So as investing comes with risk, what we want to do is employ some risk management strategy. So we want to reduce our exposure to where risk could potentially result in a loss of capital. We want to protect against and minimize our losses from investing. But diversification is not just about risk, it's also about opportunity. If you think about all the different types of investments in the world, there are so many different types with lots of different characteristics and lots of potential for returns over the long term. By diversifying, you can give yourself exposure to different types of investment that could potentially give you a greater return than if you focus on one particular type of investment. So let's take a look at a very quick and simple example of what diversification might look like. So we're going to assume that we have four different types of investment. We have investment A, which is a high risk investment, investment B, which is medium risk, investment C and D, which are low risk. In each of these investments, we're going to put 1,000 euros. Let's look at three potential outcomes and assess these outcomes. So in scenario one, you can see we've done very well for ourselves. We've made 360 euros return, which is very close to a 10% return on the 4,000 euro total that we've invested. Why have we done so well? Well, that's because our high risk investment has performed exceptionally well and has contributed to the majority of our gains. And we've also had our gains complemented by the smaller positive returns of the lower risk investments. Now let's look at scenario 2, which is a little bit less optimistic. In this scenario, we lost money on investment A, but we still made a positive return on investments B, C, and D. And as you see, we still come out with €100 profit overall, which is not great, but it's better than losing money. So as you can see, the portfolio has underperformed, and the fact that our high risk investment has not performed as we'd hoped has held us back. However, we can also see that the gains from our lower risk investments have given us, nevertheless, an overall positive return and have protected us against a loss overall. Now let's look in scenario 3. Now this is quite a pessimistic situation. As you can see, investment A has performed particularly badly and we've lost 20% of what we've invested. Investments B, C and D have all performed less well than we'd have liked as well, but they still are giving us a positive return. So overall, we can see that we're making a loss, and that is mainly coming from our high risk investment, which is investment A. Now it's not great that we've lost money, although you can see that we've lost less money because the positive gains from our lower risk investments are reducing the amount that we've lost. Now this brings in the question of what if we change the allocation, so we have less money in our high risk investment and we put more into our more safer investments. As you can see, we still end up losing money on our high risk investment, but because it has a lower percentage of our money, we don't lose as much. And as we've got a higher amount invested in our safer investments, they generate a greater positive return, which produces the same outcome as in scenario 2, where we still make a positive return due to the positive gains from them. So as we saw in the example, you can see that risk and how much you allocate to different risks can play a part in the return on your investment. And of course, this was just a theoretical example. So what does diversification look like in practice in real life investing? I'm going to show you 3 different ways you can diversify your investments in this video. So the first way you can diversify your investments is geographically. We're very fortunate to live in a world full of variety. Different countries, languages, cultures, climates, and also economies. Two common terms that you'll hear when referring to economies of the world today are developed economies and emerging economies. When we refer to a developed economy, we're typically referring to one of the established and strong economies of the world, such as the US, some of the countries of the European Union, and countries in Asia, such as Japan and Australia. These countries typically have some of the wealthiest populations in the world and some of the highest standards of life, which has allowed for the economy to grow over time to the point where it is today. However, future growth of these economies is typically projected to be much slower due to the high levels of development that they've already reached. Nevertheless, many of these countries exhibit relative political stability and have a high ease of doing business, making them attractive to companies who want to set up and do business in those countries. Emerging economies in the world, such as Brazil, India, and China, are some of the up-and-coming economies that are growing at rapid rates. And many of these countries have been able to grow relatively quickly due to the characteristics within their country or some of the resources within the country that they're able to offer. For example, Brazil has significant resources of bauxite, iron ore, and gold. China has been able to offer labor at a lower cost than countries in the West, which has attracted a lot of business over there to operate, which has allowed the economy to grow. And India has been known as an IT hub with a lot of technical expertise in information technology and computers being based within the country. Though some of these emerging economies have typically lower development levels in the country than some of the developed economies that I mentioned before, the rapid growth rate of their economies should allow for these development levels to increase over time. The growth in some of these emerging economies could be quite rapid and could produce huge returns for investors over the long term. In addition, there's a lot of long-term potential as a growing economy should typically bring up the standards of development within those countries as well. However, these emerging economies do not come without risk. China currently operates a one-party political system, and as we know, China and the US are currently in disputes over trade. In addition, countries in Latin America typically see high rates of corruption in the political space and can also be affected by natural disasters due to the climate in that part of the world. Now, when selecting your allocation by geography, it's good to know that even though the US is considered a developed economy, it still produces consistent and good returns for investors over the long term and accounts for the majority of the world's stock market wealth. So you should definitely consider giving a large percentage of your allocation to the US. For some of the emerging economies, it very much depends on your risk profile as an investor. As I said before, there is huge potential for growth, but some of the threats and problems in these markets are very real and they are struggling with them today and could potentially hold them back. The next way to consider diversifying is by sector and by industry. Now, seems obvious, right? You know, maybe a bit of money at the bank stocks, bit of money at the tech stocks, bit of money at the airlines. It's actually a lot deeper than that, so I'm going to take you a bit below the surface now. If you consider the sectors of the economy, they all behave differently depending on the nature of them. I'm going to break them down into 3 types of industry or sector and explain these differences to you. First of all, you have what are considered stable or defensive industries and sectors. Now, these industries and sectors, they're essential to the population and they provide essential goods and services that, regardless of what the economic situation is, people will be out there buying them. Some obvious examples are food and beverages, pharmaceuticals, and telecommunication. Because whether the economy is doing good or bad, people will get ill and need medical treatment, people will need to eat and drink food on a daily basis, and people will need the internet to stay connected in their daily lives to perform essential tasks. Then you have growing sectors and industries. Some of these sectors already exist and they're more or less in their infant stage, but changing trends and government policy in the world probably means that they have big potential for the future. Some examples that come to mind are clean energy, electric vehicles, and technology. What we're seeing in the world today is that governments are becoming more and more conscious and wanting to be eco-friendly. The EU, for example, has its Green Deal, which looks at the transition towards renewable energy. Many countries in the world have signed the Paris Agreement to reduce their emissions. And technology, I think we all know that it's going to play a huge part in our lives going forward. And I would even go as far to say the likes of Jeff Bezos and Elon Musk probably have ideas that they're working on that we can't even imagine right now. Finally, you've got what I'll refer to as seasonal or volatile sectors and industries. I call them this because they're very much reliant on external factors for their success. For example, airlines and hotels are very much reliant on people's ability to travel easily and that people have the money to be able to spend on travel and holidays to be able to do well. Additionally, you have commodity companies such as oil, gas, and gold mining companies, and their profits and revenues are very much tied to the price of these commodities. So when the price of oil is high, for example, oil companies tend to make big profits. And when there's an oil crisis like there was earlier this year, the rest is history. Now, how you allocate your portfolio based on these sectors, it very much depends on the economic and stock market cycle. If we're at a stock market high, and we have been for several years, then there's a good chance that a recession could be coming. So you might want to play it safe and move towards some of these more defensive sectors. However, if we're in a recession like we are now, and there's potential for a recovery over the long term, then you might want to take a chance and be more biased towards these volatile or seasonal companies. Now, this may sound counterintuitive, but I base this on Warren Buffett's philosophy: be greedy when others are fearful, and be fearful when others are greedy. The final way in which you can diversify is by asset class. And what I mean by this is what type of investments you're investing in, whether that's stocks, funds, ETFs, bonds, real estate, etc. If you want to find out more about some of these investments, then I suggest you check out a prior video I did where I talk about how to start investing in stocks, shares, funds, and ETFs. With that said, what I'm going to do in this section is focus on the advantages and disadvantages of some of these different asset classes, starting with stocks. Now, stocks are a great investment to hold. It's like investing in a business. You're essentially a part owner of that business. Warren Buffett is a huge fan of stocks and he believes in stocks over the long term. Some of the advantages that stocks offer you include the potential for long-term growth if this is a good business or if this is a stock with big potential for growth over the long term. And you can receive dividends from some of these companies out here, so there's a tangible, regular cash flow coming in on your investment. However, investing in individual companies can be quite tricky to get right because it requires an understanding of finance as well as of the business to be able to make sure you're investing in the right stock. Not to mention that this is incredibly time consuming doing all the research on this. In addition, depending on how much you invest and how you invest, only holding a few companies is not effective diversification, and it could take you time to build up a sufficiently diversified portfolio in stocks and shares. Next, we have ETFs and funds, which typically perform very well over the long term as they aim to beat the market or at least replicate it in the case of most ETFs. They're very easy to get involved in and they already come pre-diversified for you with a range of stocks in those funds. In addition, you can buy these ETFs and funds readily diversified based on some of the factors before that I mentioned, such as geography and such as sectors of the economy. For example, you can buy UK ETFs, US ETFs, Euro ETFs, you can buy clean energy ETFs, you can even buy ETFs that contain companies focused on video games. That's how diversified you can get with ETFs. Not to mention that this ready diversification, it is much more cost and time effective than researching individual companies. I actually struggled to come up with drawbacks for ETFs and funds, but I would say that if you wanted to have your own allocation, you would have to complement your ETFs and funds with either additional funds and ETFs or buy additional stocks and shares on the side to be able to get your desired allocation. The final asset class I'm going to touch on is real estate. So I've not talked about this yet on the channel, but I hope to be talking about it a bit more going forward. Now, real estate is a very exciting asset class, as once you buy a property, you can rent it out and generate significant additional income from it. That income that you generate from real estate can be used to pay off the mortgage of an existing property, or you can even use it to put towards another property and eventually build your own property empire. Who doesn't want that? Obviously, real estate comes with some major considerations though. You will often need a large outlay to put down a deposit, and to be able to get a mortgage, you will need good credit score. It's very important that you get your calculations on costing and return on investment correct. Otherwise, you could end up not making the return you expected or even losing money on your real estate investments. And obviously, being a landlord, you'll have all the problems that come with it, such as repairs on the house that need doing, perhaps if you've got a problem with your tenant, needing to occupy the rooms in the house, the list goes on. So considering asset class allocation, investors typically recommend a large percentage in ETFs and funds due to the ease of operation and due to the fact that a lot of people actually don't have what it takes to be able to successfully analyze a company and stock pick correctly such that they can make a good return on the investment. That's not to say don't invest in individual stocks, but if you do decide to invest in individual companies, you need to do your research properly and you need to understand exactly what you're investing in. And when it comes to real estate, this can of course be a very nice investment, very lucrative, but you need to plan it out correctly and don't concentrate a large portion of your investments in real estate. So to summarize the video, every investor should consider diversification as it allows you to manage risk properly and take advantage of opportunities. The three ways that we've covered in which you can diversify is via geography, via industry and sector, and via asset class. How you allocate is very much up to you, but as we've seen, there are certain things that may mean that you want to hold more of one asset class, more of one geography, or more of one industry than others at a particular point in time. That's all for today's video. Hope you enjoyed it. Be sure to check out the Millennials with Money social media and internet pages. See you on the next video. Let's get this money.